Hi, everyone. If you look, you can see that's not exactly what we had planned here. So on the agenda, but for this next slot, but at this time, uh, we're going to hear from Scott Walla telling us about how monetary policy has changed and how you can adjust your teaching to make sure it's changed too. And stay tuned. Jeanette Bennett should be with us later. So Scott, thanks so much.
All right, I'm happy to be here, and I'm assuming everyone can hear me. I do want to remind everyone that the views expressed in this presentation are not the views of the Federal Reserve Bank of St. Louis, the Federal Reserve Board, or the Federal Reserve System, but we are going to be talking about monetary policy, how it's changed, and how that might impact your teaching. So let's take a little trip back in time to 2008. If you remember that time, there might be some unpleasant memories when it comes to the economy. So you might remember that we were in the midst of a global financial crisis. The stock market had taken quite a dive. House prices were sinking, which was one of the large problems that was kind of undergirding the financial crisis. And there was a general decline in household wealth because of the previous two factors, the decrease in stock market values and housing. 2008 was also the year in which the Fed stopped using its policy toolbox that we call the limited reserves regime toolbox, and that is open market operations, the discount window, and reserve requirements. Most of your textbooks more than likely say that these are the tools that the Fed uses to conduct monetary policy or to implement monetary policy. But in fact, the Fed stopped using those tools as the toolbox in 2008. Some of these tools were transferred to the new toolbox, but they're used differently. So just a quick review. This is how we used to think about monetary policy prior to 2008. The Fed controlled the supply of reserves in the banking system. Sometimes we call it the money supply, but in policy terms, we're actually talking about the supply of reserves. And the Federal Reserve, the market desk, open market desk at the New York Fed would go into the market and buy and sell Treasury securities on a daily basis to fine-tune the federal funds rate. So that action would shift that supply curve back and forth. And that shifting of the supply curve would adjust the federal funds rate. The key factor here is that the supply curve intersected the demand curve in that downward sloping portion. And so a very small change in supply was enough to adjust the federal funds rate. Again, this is probably the way most of your textbooks are describing the fact or the way we do policy today. But that is no longer the case. The global financial crisis, the Fed's response to the global financial crisis here, we have the Fed lowering the target range to what we call the zero lower bound. Actually, the range from 0 to 25 basis points. The Fed conducted a series of large-scale asset purchases, sometimes called quantitative easing. And as a result, it boosted reserves in the banking system to over 2.8 trillion. If you see the FREEI graph at the bottom of the screen, you see that the left-hand screen might look like there's no data there, but there's a small bumpy line there. It's just that relative to the right-hand side of the graph, it's almost not noticeable. So you can see that the Fed's balance sheet increased pretty dramatically starting in 2008 as a response to the great financial crisis. So when it came time for liftoff, and liftoff is a reference to, that when the Fed would raise the federal funds rate above the zero lower bound, this caused a little bit of a problem. The Fed had been discussing an update to its tools for quite some time before the financial crisis, but this opportunity lended itself to launching those new tools. And so you see before 2008, this is what we just discussed before. The supply curve is in the downward sloping part of the demand curve. But as the Fed responded to the financial crisis and pushed a lot of reserves into the banking system, it shifted that supply curve way out to the right. Okay, and you can see that on that right-hand graph, you see the federal funds rate is at 0. And using the old tools, this would have required reducing the supply of reserves pretty dramatically to get interest rates back up into that normal range. The Fed had decided that there are advantages to operating with what we call ample reserves. Ample reserves is where the supply curve is towards the right-hand side. It's to the right of the downward sloping portion of the demand curve, right? So today, this is what the toolbox looks like. This is the graph that we use to talk about the way the Fed implements policy. We're not going to spend a lot of time on this call talking about each of these tools, but you do notice that the green arrows are pointing to what we call the new tools of monetary policy, interest on reserve balances, or the IORB rate, overnight reverse repurchase agreement rate, which is on the graph as the ONRRP rate. The discount rate is held over from before. We think of it a little bit differently in this context. And then the supply curve. So let's focus in on the primary tool. It used to be that the primary tool of monetary policy was open market operations. Today, the primary tool of monetary policy is interest on reserve balances. So the interest on reserve balance rate is the interest rate that banks earn from the Fed on the funds they deposit in their reserve balance account. So in the limited reserves regime, banks were required to hold a certain number of reserves. They weren't compensated for that. They sometimes held excess reserves, and that also they weren't compensated for that. In this new framework, there are no reserve requirements, and banks can hold, reserves at will at their local Federal Reserve Bank, and they are compensated interest for that. So the rate, in this case, the interest on reserve balances rate, actually becomes a tool of policy. Okay, so the interest on reserve balances rate steers the federal funds rate into the FOMC's target range. So the question is, how can an interest rate be used as a policy tool? And there are two concepts related to this that become kind of essential to teaching why this works or how this works. So the first one is reservation rate. Reservation rate just says that the reservation rate is the lowest interest rate that banks are likely willing to accept for lending out their funds. So this is the minimum rate that they're willing to accept. So in other words, they won't accept a rate less than the interest on reserve balances rate. And why would they, right? Interest on reserves to those banks that can have reserve accounts and earn interest. It's a risk-free transaction. And so they have no interest in accepting less than the interest on reserve balances rate for a risk-free deposit. The other one is arbitrage, and arbitrage is really the secret sauce here. And it might sound intimidating, but I think introduced correctly or in an easy way, I think students will warm to the idea of arbitrage pretty quickly. So arbitrage is simply the simultaneous purchase and sale in order to profit from a difference in interest rates. So let's talk about how this works when it comes to policy. So here you see two options that banks have for their reserves. So banks can either lend their reserves in the federal funds market, or they can deposit those reserves at the Federal Reserve. If they lend, or borrow in the federal funds market, they receive or pay the federal funds rate. If they deposit funds at the Federal Reserve, they receive the interest on reserve balances rate. And so in this scenario, let's say that there's a difference between these rates. In this scenario, the federal funds rate is lower than the interest on reserve balances rate. Banks would quickly see an opportunity here. They would see that they could go into the federal funds market and borrow at 2% and deposit those funds at the Federal Reserve for 2.5%, or earn 0.5%, which we call 50 basis points. And so, because these are both short-term rates, because they have a similar risk, involved, they're seen as almost interchangeable transactions. And so any difference between them gives banks this opportunity to profit. Of course, this one bank in the picture wouldn't be the only bank to realize this. So a number of banks would jump into this market, borrow at the federal funds rate, deposit those funds at the Fed to earn the interest on reserve balances rate, and that increase in demand would push the federal funds rate up to 2.5%. Okay, so in other words, arbitrage will ensure that any gap between these two rates is minimized. Let's think about it from the other way. Okay, so in this case, what if the federal funds rate is higher than the interest on reserve balances rate? Okay, well, arbitrage works here too. In this case, banks would withdraw money from their reserve balances at the Fed and lend in the federal funds market at the higher rate to earn that profit. This is the arbitrage action. Remember, taking advantages of the difference in price, or in this case, rate. And of course, as those banks, were attempting to lend more and more money in the federal funds market, that increases the supply of reserves and pushes the federal funds rate down to the same level of interest on reserve balances. And so arbitrage ensures, this is kind of the point here, that arbitrage ensures that that there will be negligible differences between the federal funds rate and the interest on reserve balances rate. Now, because the Fed controls and sets the interest on reserve balances rate, all the Fed has to do is change this one rate, and arbitrage will ensure that the federal funds rate follows. Okay, so when it comes time to implement policy, here at the top, it says when the FOMC sets the target range for the federal funds rate, the Fed then chooses a level of the interest on reserve balances rate that will encourage the market determined federal funds rate to fall within the range. Okay, so there's really two steps here. We talk about conducting monetary policy and implementing monetary policy. When we talk about conducting monetary policy, that's where the FOMC sets the target range for the federal funds rate. And you might remember just recently the FOMC raised the target range for the federal funds rate by 75 basis points, or 0.75%. Okay, so they moved the target range higher. At the same time, if you read deeply in the documents, you'll see that they also adjusted the interest on reserve balances rate. And when they adjusted the reserve balances rate, the federal funds rate shifted up into the target range. Okay, so in summary here in the lower left-hand box, when the FOMC conducts policy by raising the federal funds rate target range, the Fed also raises the interest on reserve balances rate, which moves the federal funds rate into the target range. When the FOMC lowers the federal funds target range, the Fed lowers the interest on reserve balance rate, which moves the federal funds rate into the target range. Okay, so instead of going into the open market and buying and selling treasuries to shift that supply curve back and forth, the Fed simply adjusts the interest on reserve balances rate, and the federal funds rate follows. Okay, so when we say that the interest on reserve balance rate is used to steer the federal funds rate, that's really what it's doing. So interest on reserves is the Fed's primary tool for influencing the federal funds rate. Okay, so what about open market operations, right? So for years, decades even, we've been talking about open market operations. If you look on the things that we've written or the board website, it's still listed as a tool, okay? It is a tool, and the reason it's still out there is that this system works if the supply curve is far enough to the right that it's not in that upward sloping or downward sloping part of the demand curve, right? We don't want the supply curve kind of coming back and getting into that sloped region. And so open market operations are used periodically to maintain what we call ample reserves. Also, when the Fed uses some of its tools, so for instance, quantitative easing is a form of open market operations. Those are used, not often in periods where the Fed wants to affect other interest rates. And then actually one of the other tools that the overnight reverse repo rate is technically open market operation, but used differently than what we've been talking about. So we still list open market operations as a tool, but it's really when we list them, we talk about the 4 tools of monetary policy: interest on reserve balances rate, overnight reverse repo rate, the discount rate, and then we list open market rate operations as a 4th tool. But we try to minimize it because really it's interest on reserve balances that is the tool that the Fed uses to guide the federal funds rate. So the question here is, has policy changed enough to justify changing my instruction? So we've been doing these presentations. We started this project about 3 years ago. We've done a number of presentations, and sometimes we get a little feedback like things really haven't changed, right? That and they have, right? So this is an entirely different regime, and I'm going to show you a few pictures that hopefully show that. So on the left-hand side, you see what we call the limited reserves framework. This was what the Fed used prior to 2008. On the right-hand side, you see the ample reserves framework. There are some differences in the lines, but I think this animated figure really shows the difference. So in the left-hand side, you see this is the limited reserves framework prior to 2008. On the left-hand side, you see the supply curve shifting. On the right-hand side, you see the ample reserves regime, which is the way the Fed currently conducts policy. And in this scenario, the Fed moves these 3 what we call administered rates. These are rates that the Fed sets: the interest on reserve balances, overnight reverse repurchase agreement rate, and the discount rate. The Fed just moves them in unison, and that guides the federal funds rate. I didn't talk much about overnight reverse repo rate. That is, it serves as a floor for the federal funds rate, and the discount rate serves as a ceiling for the federal funds rate. And I'll point you to some resources where if you want to read more deeply or learn more about those rates, we have a lot of information out there. But by moving these 3 rates up or down, they directly shift the federal funds rate up or down.
Hey, Scott, these shifts are really cool. I hate to interrupt you, but there are some questions in the chat. And so before people, get all fixated on their question and miss out other important things you're sharing with them, somebody asked who officially in the Fed raises the IORB rate?
So, right. So the ROB is determined by the Board of Governors. The FOMC, Federal Open Market Committee, sets the target range for the federal funds rate, and then the Board of Governors determines the IORB. Because the reserves are held at reserve banks, it's actually reserve banks that pay the interest on reserves. And so there's, when we, you might have noticed I said, FOMC does this, and then the Fed more broadly does this other thing, because there are other entities kind of involved. But yes, the Board of Governors determines the IORB, and then those reserves are actually held at reserve banks.
And there are a couple more. One is, do introductory textbooks discuss this new system with ample reserves and Fed policy?
That is a great question. In fact, we just published a paper where we looked at 8 of the best-selling college textbooks, and one of them actually described this new the new framework. And I say new, but as one professor reminded me, I was presenting this, and they said, well, if this regime was born in 2008, this regime practically has a driver's license now. I mean, so this has been around for a number of years. But textbooks, I think, are just getting on board. If you are an AP macro teacher, you realize that just recently the College Board revised some of their benchmarks to reflect some of what's happening here, and I think that will be an incentive for textbook companies to respond with updated information. In the meantime, one of the goals that my co-author Jane Eyrig and I had in this was to not only make sure that people knew about it, but to produce a number of resources to help teachers and college professors gap the time frame that it takes for textbook companies and curriculum developers to adjust their resources. So I'll be talking a little bit about the resources that are available to kind of help you bridge the gap until textbooks are up to date.
That's great. One last question, and then I'll leave you alone. What would cause the ample reserves to decrease so that the Fed, for the Fed to purchase securities?
So this might be, just securities maturing, banks deciding to do other things to start lending funds and so on. And so the balance sheet, as we say, will eventually just kind of roll off as the securities on that balance sheet mature. And so the Fed will from time to time have to use the open market desk to make sure that the reserves in the portfolio are ample.
Great, thank you.
Yep. So this is kind of a secondary, description. The top level here is the old regime limited reserves, and again, it shows the supply curve shifting right, and then you see the federal funds rate shifting down. And of course, back in the limited reserves days when the Fed conducted open market operations, they also adjusted the discount rate oftentimes as well. So that's reflected. And the lower you see the ample reserves regime. So again, it's just shifting those rates downward. And as those rates shift downward, the federal funds rate shifts at the same time. So teaching recommendations focus on the Fed's administered rates. So the administered rates are the interest on reserve balances, the discount rate, the overnight reverse repo rate. Again, those are administered rates, so they're rates that we set. Teach reservation rate and arbitrage as the key concepts, especially arbitrage. I think if students understand arbitrage, they will quickly realize that, this is really an easy process, that all the Fed does is shift that one rate up or down and the federal funds rate falls in line. Refocus monetary policy discussion away from how the Fed influences the money supply and toward how interest rates affect the decisions of producers and consumers. This one can be a little tough for some professors and teachers who have been teaching for a long time, because of a lot of the models in your textbooks are built on a money supply framework. So for instance, the money multiplier, there are a lot of content in your textbooks that are built on this assumption that the Fed uses the money supply to affect the economy. Actually, when the Fed shifted regimes, we now use interest rates as the mechanism by which we influence the economy, not the money supply. And so for number 4, we recommend dropping the money multiplier. We have an article that I'd be happy to send you that kind of explains exactly why the money multiplier should, fade off into the future or fade off into the past, and explains exactly how to think about banks and their influence in the economy today. And number 5, we propose using this flow diagram to talk about, how policy affects the broader economy. So in this little simple flow, we have the FOMC setting the target range for the federal funds rate. The red arrow is where the tools come in. Okay, so this is where the Fed uses the tools to shift the federal funds rate into the target range. That next green box, okay, the higher or lower interest rates affect market interest rates and overall financial conditions, which influences consumers and producers' spending decisions, which allows for progress toward the Fed's dual mandate of maximum employment and price stability. I did mention that we have a number of tools and resources for teachers and professors to use. In fact, we built an entire web page And the second part of the page is actually here, but we've segmented them. We put classroom resources right at the top. I'll be talking about a couple of them. We've written a number of articles for different journals and different audiences. We've done a number of blog posts on the topic. We've done several webinars. Some of those have been recorded. We have a recorded lecture. We did a podcast, and then we do have a digital badging program, which I'll be talking about just in just a minute. But I do want you to make sure you're aware of this webpage, because we do have a number of great resources out there. Right here at the top, classroom resources. I have some slides here to highlight some of those at the end. I do want to talk to you about badging just for a minute. So the badges are digital badges that serve as that allow you to earn a micro credential. And of course, you can't just put monetary policy out there. You know, it really requires some context. And so the context are these badges that lead up to the monetary policy badge. So the first one is, Educator's Guide to Economic Output. So our system works in Canvas, and so you'll go in, you'll watch a video, you'll read some content, you'll take a few quizzes to ensure that you have a good understanding of the content, and then you'll pass on to the next module, which is on price stability. Talks about how the Fed thinks about inflation, how inflation is measured, all of this in the context of monetary policy. From there, you pass to maximum employment. Again, this isn't just like your textbook definition of employment and unemployment. It's really in the context of how the Fed thinks about employment and maximum employment. And then you go through the next one, which is the Fed and the dual mandate, which is an introduction to kind of the Federal Reserve System, but really the policymaking side of the Fed. So we talk about the Federal Open Market Committee, and then we get to the Fed's toolbox, and that's where you really dive in and learn about each of these tools individually and how they're used. And once you've earned each of these 5 badges, you'll earn an additional micro credential. This is a digital badge that you can share on LinkedIn or put under your email line. In fact, if you send me an email, my response has my little badge right underneath my email signature. To find this, you can actually start on that page that I was talking about before, that page where we kind of list everything. But we do have a landing page specifically for these badges. And then there's a link here at the bottom, okay? When you click this button to register, you go to a typical registration form. You select that this is the badge you want. Then there's another page that asks for just some key information. And from there, you'll get an email. That email will have a link in it that takes you to our Canvas instance. So when you click that, you go to our Canvas instance. If you don't have a Canvas account, you can start an account here. You don't have to, have a Canvas subscription or anything. You just create an account to log in. If you use Canvas a lot already, you can use your credentials, log in here, and you jump into the content. This is what it looks like for students. So there's an introduction, there's some key tips on navigation, there's a Q&A where you can provide some feedback. If you need some help, we keep an eye on that. And then you start working through the content. I took a few screenshots. We use live FREEI graphs in the content. So this is the federal funds rate target range. These are living FREEI graphs, as I said. So you see actually on the right-hand side, you see the recent increase in the federal funds rate target range already reflected on that graph. We use video, so we have embedded video. So we tried to make it, as interactive and informative as possible. At the end, you'll get a message in your email. It says you've earned a badge from the Federal Reserve Bank of St. Louis. And when you click accept your badge, you go to Credly, and Credly allows you to download the badge. These are some people on LinkedIn who have gone through the courses, gone through the various modules, and are displaying their badges proudly on LinkedIn. So there are people out there that have been working on this already. A few of the teaching resources that we have available on that webpage. This is a lecture guide, so similar to a lesson plan, but really it is a lecture guide, and it comes with slides. And so we sometimes get questions about, can I use the images, or where do I find this graph that I saw in your slides, or can I have your slides? You're happy to have my slides, or you're welcome to have my slides. But if you want, you can go right to our webpage, download the lecture guide, and download this set of slides, which many of the images in my slides are taken actually from this slide deck. And then there's also this kind of graphic organizer study guide. So really, this is kind of a lecture in a box, right? So you put the slides up, the lecture guide actually tells you on slide 1, make sure you say this or mention this, and it takes you through the entire slide deck point by point, and gives you the language you need to give a lecture on this, and obviously you can adapt it however you like. And then the study guide is there to kind of help students organize their thoughts, and helps you kind of see if they're tracking well. It's one resource. Another resource, we have an online learning module in Econ Lowdown. This is monetary policy, again, in a box, even more so, right? So that you create up an Econ Lowdown account, you send your students the credentials, and really that's the only thing you have to do. Once students log in, students get all the content, all created, all there. There's a pre-test and a post-test. There's interactives, checks for knowledge. And so this allows you to expose your students to this content without you don't even have to teach it, right? This is really kind of a totally hands-off approach to making sure your students get the content without you having to direct it or to do it directly in class. You could use it in a flipped classroom setting, or to reinforce learning, or this could be the treatment entirely if you want it to be. We have a page 1. This one, we published one 3 years ago. That was one of the first publications for teachers and students on the topic. That one was written when we still had reserve requirements. So this is the replacement. This was published just this last May. But how does the Fed use its monetary policy tools to influence the economy? Again, this is written with like high school, college students in mind. You'll notice the bold words. We define the words along the way. We describe it. Some of the images that I've used are used also in this document. And then it comes with an assessment piece here that you can choose to use if you want to see if your students are tracking. And there's an answer key available in Econ Lowdown. We also produced a series of videos. We want to make sure this is as easy as possible for you to do in the classroom. We broke it into 4 parts. You'll see this first part is 3.5 or almost 4 minutes. The Fed and the dual mandate, 2 important interest rates, reservation rate and arbitrage, and the Fed in action. So again, these 4 videos combined are 16 to 20 minutes roughly. And you can chunk it how you want. You can put it in your Canvas account. You can show them in class, whatever is easier for you to do. Again, this is just the page for the badges. And I also want to mention we're hosting a webinar on August 3rd to talk about this. So my co-author and I, Jane Eyrig, are working a lot on this. We've given a number of webinars. There is a renewed demand for this type of content with the College Board adjusting its benchmarks. So we want to make sure that not only all those resources we've already put out there, but we give you an opportunity to hear it live and to ask some questions. So please feel free to register. It's free, August 3rd, and there we go. That was a lot. Any questions?
Hi, Scott. There were a number of questions in the chat. Someone was wondering if they can actually integrate Econ Lowdown into their platform, the D2L. I don't know about that. Maybe Asher could answer that question. Someone else was wondering about, is there a citizen guide or are there badges for individuals?
Yeah, those are 2 great questions. I'll answer those before we go on. But yes, okay. There's actually 2 versions of those badges. One is called a Citizen's Guide to Monetary Policy, and the other one is an Educator's Guide. the content is almost the same. If you do the educator one, at the very end of the module, it has links to all of those teacher resources and so on, where the Citizens Guide, isn't necessarily framed as for teachers, but it's essentially the same concept, or it's the same content. The other question, I'm sorry, I already forgot.
Oh, that's okay. Well, another question was, can students get these badges?
Yes, like you could assign the Citizens Guide to monetary policy, and I think that'd be a great treatment. The other question was about the platforms. We have an LTI link with Canvas, so if you use Canvas, you can pull Econ Lowdown right into your Canvas account. The other platforms, we currently don't have that same, but for instance, I used to teach with Blackboard as an adjunct, and of course I'd set up an account in a syllabus in Econ Lowdown, and then I would just provide the links in my Blackboard account to link the two. So it's not, instead of pulling Econ Lowdown into your LMS, you could easily link from your LMS back to Econ Lowdown.
Another question we have is a teacher says, all my resources have always showed the Fed as having 3 goals. The first being the GDP growth, the second full employment, and then price stability. She said, I've only heard and seen from 2 and 3 talked about today. Why not number 1?
So yeah, we usually refer to the dual mandate, right? The price stability and maximum employment. If you actually go back and read the official documents that Congress passed down, something like low long-term interest rates are there as provided as a third. The assumption would be that if the Fed does the low and stable prices and maximum employment piece correctly, the interest rates take care of themselves.
Thank you so much, Kat.
It'll lead to GDP growth. I mean, it's just a given. And so GDP growth is in and of itself has not been listed in any of the documentations from the Fed as a goal, but realistically, it's an outcome that would happen because you have maximum employment and you have stable prices.
Right. In fact, right, there aren't any goals about GDP. If you look at one of the great pieces, I'm a Fed nerd, but I really like looking through the summary of economic projections after FOMC meetings. They issue those 4 times a year, and in those meetings, or in that documentation, FOMC members give their outlook for 4 economic indicators, and that is unemployment, inflation, GDP, and then the federal funds rate. And of course, GDP is there because it's kind of the best measure we have of the entire economy, and because it informs the rest of the data. But again, we don't have a mandate specifically about GDP.
Thanks, Brian. Go ahead and post that question in the chat, and I'll ask him. Oh, actually, a previous question from Brian was, can banks collude together in secret to create an outcome to fix rates?
Well, I guess I've never been asked that before. It's a pretty competitive. So interest rates, especially things like short-term Treasury rates are pretty competitive. I'm not sure if colluding, would be very successful in influencing, some of those key interest rates that we're talking about. And they wouldn't work for the federal funds rate because, if the rate got too far off of the interest on reserve balances rate, there would always be that incentive to earn profit. So as the two rates, get farther and farther apart, the incentive to earn a profit increases.
I think he's happy with that answer.
Okay.
It's very complicated. And thank you so much. So many people are saying thank you. It was a great presentation.
Yeah, thank you. And again, feel free to reach out. And we do have that webinar coming up in August, so it'd be great to see you all again. Thank you.